Welcome everybody to the Elevation Market Update. I'm Deborah Trow, and this morning I'm pleased to have Noelle Doiron of T. Rowe Price Investments with us. Noelle will be giving us a little bit of a presentation, and then I'll have some questions for her. If you have questions, feel free to put them into the chat, and we'll see if we can get those answered as well. First of all, let me tell you a little bit about Noelle. She joined T. Rowe Price in 2018, and she works closely with the portfolio managers and the analysts. Before that, she worked in bond investing. Noelle lives in Scottsdale, Arizona with her husband, her 18-month-old daughter, and their 2 dogs. So I'll turn this over to Noelle now to talk about what's happening in the markets, please.
Thanks, Deb, and thanks to the team for your patience and everyone on the line for your patience this morning. Even, many months and years through COVID now, we still have these technical glitches, it seems like. But again, thanks for the time. I think to start out, what I always like to tell people when I'm making these presentations is, I don't really care which investment guru or economic specialist you were listening to late last year, early this year, but no one has really gotten this year completely correct, right? I mean, we all knew that maybe things were going to be a little bit shakier in terms of growth, but in terms of the impact on portfolios and just bottom lines to our wallets, it's been a challenging year. So let's just state that first off. But what I'm really going to focus on over the next couple of minutes or few minutes is threefold. First, we'll talk a little bit about what the Federal Reserve has been doing. Next, and more positively, we'll talk about why we shouldn't be panicking in this environment. And then finally, we'll put some context around where asset prices sit today and where there may be relative opportunities as well. So let's get started with the Fed. And if we think about our modern day Federal Reserve, they really have a mandate to focus on 2 data points, and those are inflation and employment. And they've got a few levers they can pull in order to try to control inflation and employment. So in a weak environment where we have high unemployment, the Fed is going to try to make it easier for companies to do business and hire workers by cutting interest rates. Obviously, that is not the environment that we are in today. We're in the opposite environment where inflation has been running very high at record levels and in some months, as we've seen this year. So in that kind of an environment, the Fed has to raise interest rates, and they're really trying to put a hammer down on demand. So they're trying to keep us from buying certain goods and services. And in some cases, they are trying to kind of deter companies from hiring more and more workers to try to get this inflation down to a more normalized range. But what does that mean for your investments? And this is where we'll focus on the graphic that Mike, thank you for putting this on the screen here. This is where we'll start focusing on this graphic. So there's 2 main components to investment portfolios. The first is bonds and the second are stocks. The relationship between yields or interest rates and bond prices is pretty easy and simplistic. As interest rates go up, bond prices go down. So that's why you saw, especially earlier this year, a very dramatic decline, probably in your bond portfolios more than you've seen in quite some time, maybe in your investment career or lifetime. And then how that feeds into equities when the Fed is hiking rates, and this is what we're showing on this slide here. The blue line indicates expectations for Fed hiking cycles. So if you look all the way over to the right-hand side, which is where we're at today, you'll see that these expectations went up dramatically. I mean, more than we've seen in well over a decade, if not close to 2 decades here. And those, the hike in interest rates that we expected also had an impact on our stock investments. Because as you can see, when that blue line is going up pretty dramatically, we've seen this in different periods over the course of the past several decades, when that blue line is going up, when expectations are going up, the relationship between stocks and bond prices tends to go up. And as we, excuse me, as I just mentioned, bond prices went down. That means, unfortunately, stock prices went down as well. So there just hasn't been any great places to hide in the first half of this year. Mike, if you'll turn to the next slide, I think it's time to focus on some good news. This is why it's not time to panic. And we'll talk about two different components of the economy here. So first, let's focus on economic growth. And what we're looking at here is called the ISM Manufacturing Index. And it's probably the most common measure of economic activity. So on the left-hand axis, you'll see different levels of that index. Anything below a 45 typically means that we're in a recessionary environment. Anything below 50, so between 45 and 50, tends to be a weaker economic environment, but not necessarily categorized as a recession. If you look again to where we've been post-COVID, we saw this index at its highest level since the early 80s. So really great starting point post-COVID from an economic activity standpoint. And yes, economic growth, economic activity is fading. It is not yet below 50. In July, it was 52.8. So still a healthy economic environment here in the US. But what I really like to focus on here is that if your view is where you think we're going into a recession, the likelihood of that recession being long, deep, drawn out is very slim based on how strong of an economic environment we've seen. And I think the even better news, Mike, if you want to flip to the next slide, is the health of the consumer and of corporate America, because these two very important components of our economy are incredibly strong on an absolute basis and relative to history. So I'll kind of highlight what you're looking at here, and then we'll focus on what's important. So the green line is going to be the corporate line, the corporation line. The blue line is going to be the household or consumer line. Consumers are measured on the left-hand side and corporations are measured on the right-hand side. And we're basically looking at both household, really consumer, and corporate cash to loan ratios. So this is really the amount of leverage that these companies and these consumers are carrying. And if you focus first on the consumer, so the blue line, the consumer cash to loan ratio today is over 100%. It's not as high as it's ever been, and that's probably because of the advent of credit cards. We'll probably never see it as high as it was, in the 70s and 80s, but it is very high relative to modern or recent history. And I think what is more dramatic is if you look back to like the 2007, 2008 timeframe, we're double where we were then. So households and consumers are just they're just in a much healthier spot to be able to withstand any deterioration. And corporations, they're as strong as they've ever been in terms of their cash to debt ratio. So this is, I think, some of the best news that we can point to in our economic environment. And then the final slide I have for you, if you want to turn to that one, Mike, is just where valuations are today. And what we're going to be looking at is valuations of different asset classes relative to where they've been over the past 15 years. So if you were to see a bar that was touching the 100% level, that would mean that that asset class is as expensive as it's been in the past 15 years. Now, today we're not seeing that. If we were sitting here a year ago, we'd see multiple bars that were close to 100%, if not at 100%. But there are two things that I like to point out here. First, is it feels like this has been a rough economic environment, but if you really look at where valuations are, especially for US large caps, and even if you look at all the way on the right-hand side, IFA growth, that's international growth, we're well above our medians here in terms of where we've been over the past 15 years. So still in a pretty good spot from a stock market standpoint. Bonds have suffered a lot more. But then the second thing I'd point out is there are multiple asset classes that are very attractive today from an entry point. So that's something, to think about and look at with Deb and the team if you're interested in being a little bit more opportunistic, if your plan and your long-term goals allow you to do that. So just to kind of wrap up my prepared remarks, I would say from a market volatility standpoint, all roads or most roads lead back to the Fed. Good news still exists here in our economic environment with US consumers and corporations. And then finally, if you're fortunate enough to be a long-term investor, there are good opportunities in the market stage to be thinking about. So thank you, Mike, for running these slides for me. And with that, I'll turn it back over to Deb.
Thanks, Noelle. Thanks for telling us about current market conditions and what's driving what we're seeing happening. You touched a little bit on this, but I think the big question is, are we in a recession now?
Yeah, and that's something that my colleagues and I talk about a lot. If you are kind of a market junkie or addict or whatever you want to say, you might listen to some podcasts that debate this from time to time. And I like to joke that you can't, I mean, it's not a joke, recession is not a joke, but I like to say that, you know, whatever your view is, you can probably find some data points that will support that view. So if you were in the camp that you think we're in a recession, your first data point is probably going to be, well, we've experienced 2 consecutive quarters of negative growth, and that is a recession. You may also point to, we had some existing home sales that came out today that weren't super strong, a little bit weaker than we've seen. So there are data points to say, yeah, this is a tough environment. But I am in the other camp. I'm not going to say that we're not going into a recession, but I am going to say that I do not think we're in one now. And the main reason for that is jobs. If you look back to 2008 and 2009, we lost 8.5 million jobs. In June and July alone, we've added 1 million jobs. I just do not think we can be in a recession and add 1 million jobs in this economic environment. So I don't believe we are, but you can certainly find a data point to prove your point.
Yeah, and a great point you made that if we are heading into recession, this isn't 2008 where we really had such a drop for such a long time. But we did get some good news recently, didn't we? A recent report said that inflation, the rate of inflation had ticked down just a little bit. What else can you tell us about inflation?
Yeah, and that is great news. That's what we all want to see. That's certainly what the Fed wants to see. And I would say we're chipping away there. I mean, it hasn't come down dramatically. It's still running high. And it's probably going to look a little high for the next, month or two at least. The Fed and what they're able to do tends to have a lag impact. So, you may not expect to see their real work being done from an inflation standpoint for another month or 2 months. But then we should start to see the Fed's work paying off. But the other inputs for inflation that we're starting to really see come down, gas prices is still not where we'd all want them to be, but they've really fallen. And we expect that gas prices to continue to fall as the demand for summer trips and things like that. Kids are going back to school now. That demand for road trips and air travel, that's going to come down in the fall. Other input to inflation, home prices. We're seeing home prices cool off this summer, which is pretty rare in a summer environment. That's typically a time where people like to buy homes, and that's when home prices go up. But those are 2 really important components leading into inflation. And then the last thing that I'd say about inflation and why you should expect it to come down is CPI. Whenever we get these CPI or PCE numbers that measure inflation, we're looking at year over year inflation. So we're looking at July 2021 compared to July 2022 and how much prices have gone up in that 1-year time frame. So you're always measuring against a base. Our base now is very high, and it was kind of towards the second half of last year as well. So with a higher base, it gets a lot harder to hit higher and higher numbers. So really 4 reasons why we expect inflation to continue to come down.
Very good. Well, T. Rowe Price has some of the funds that we put into our clients' portfolios. So tell me a little bit about how they are approaching their stock selection process for a fund, and how are they managing our mutual funds that we have in our portfolios?
Yeah, great question. And it's the reason that you all invest with T. Rowe. Stock selection is really the main component of, our process at T. Rowe. It's what we're well known for. We have over 400 analysts who are based around the world. And these analysts, along with our portfolio managers who are managing the funds that you're invested in, they are meeting with company management on a very regular basis. They're going to company sites on a regular basis. And what's interesting about this environment, this kind of pandemic environment that we hopefully are emerging from, is that it's really brought on these virtual engagements like we're having now. And it's actually allowed our analysts and portfolio managers to have even more frequent conversations with company management. So that's how we're engaging with our companies that we're investing in. And our analysts, which is really the backbone of T. Rowe Price, those 400 folks based around the world, these individuals are really focused on niche areas of the market. So they're really focused on 20 to 30 different names. And these are niche areas like Japanese healthcare companies or US hotels and cruise lines. And that allows them to not only know their companies really well, but to know the industry, the emergence trends, the competitive forces, everything that's going on to impact those companies as well. So that is an important component. And the last thing that I will say that I like all of our investors to know is that T. Rowe Price does not rely on S&P or any of the other, rating agencies or banks to tell us what to think about a company. Our analysts are actually doing their own work, and they have what we call conviction scores, and they rate every company they follow on a scale of 1 to 5. If a company is a 5, that's a company we want to stay away from. If a company is a 1, that's a company we want to own more of than maybe a broad index like the S&P or the Russell 1000 growth owns. But those conviction scores act as a flag for our portfolio managers to get quick, effective communication from our analysts and then dig in a little bit more if they need to. So it's a really involved process, both qualitatively and quantitatively.
Well, thank you so much for giving us a little bit of an insight into how the daily work at T. Rowe happens to make those choices of companies in our funds. Let's talk a little bit about bonds now. Earlier this year, I think one of the things that really panicked the markets was that not only did stocks go down, but bonds went down as well. And that doesn't normally happen. So tell us what's happening with bonds at this point.
Yeah, the first quarter and somewhat in the second quarter as well, really difficult environments for both stocks and bonds, which is very unusual, like you mentioned, Deb. And, kind of separating stocks out of it and really focusing on bonds and fixed income. We're going back to the Federal Reserve again. The Fed, the modern day Fed, is very transparent. And some would argue probably too transparent. So they came out very early this year and they said, we're going to be really aggressive and we're going to be hiking our federal funds rate from 0 to 3 or 3.5% by the end of this year. Now, what happened at that point was market participants, so bond traders, hedge fund managers, went into the market and they said, well, we're selling our bonds. And they started selling bonds. Yields went up very dramatically. Bond prices went down very dramatically until those market participants felt like, okay, this is kind of fair value for where we think the Federal Reserve is going or where they're going to be. So that's why, and I want to separate the first quarter from basically April through July. So in the first quarter, if you look at 2-year yields, so 2-year bond yields, treasury bond yields, they went up 1.7%, which is incredibly dramatic. That is a big shock to bond prices, which again, remember, go down as those yields go up. The Federal Reserve only hiked 0.5% in the first quarter, and 2-year yields went up 1.7%. From April to July, the end of July, the Federal Reserve hiked 2%, and those 2-year yields went up 0.43%. So the market did a lot of work early on. And really what that set up your portfolios to do is have bonds today that act a little bit more like bonds, you're getting income, you're getting a little bit more protection and cushion with yields higher than they were in the beginning of this year. So our view is that, it's not a perfect environment here today with fixed income and bonds, but it's going to be a lot better than what we experienced in the first quarter with that dramatic move in the market.
Yes, and I'm actually seeing that in the reports for our clients' accounts, stacking up against the S&P 500 benchmark, that we can see that smoothing out process happening again, which is, it's great. So let's talk back to stocks again. Something that people sometimes worry about is, are we having another tech bubble? All those really large companies that people were buying a lot of, Amazon and Google and Tesla. What does T think?
Yeah, so, I would say to that question, Deb, mainly no, but a little yes. So let's go back to the tech bubble real quick. So if you remember back in, 99, 2000, there was a huge excitement about all of these really innovative ideas and, access to the World Wide Web. Really exciting things were happening, and investors and really smart people, like, folks that are peers to us at T. Rowe Price, people got really excited about these innovative ideas and they bought them. And really these companies, they had no sales or revenue or anything like that yet. But the bigger problem was that there was no real infrastructure for them to be able to carry out these innovative ideas that they had. So the tech bubble was really about ideas. What we've seen since then is we've developed the infrastructure, we've developed the technology to be able to carry a lot of these great ideas forward. And so a company like Amazon, a company like Tesla, a company like Microsoft, these are not companies that are going anywhere. They are very, very well-run businesses. And, you can see that in their innovation and their financial statements. So these companies will continue to do well. Now, why I say somewhat yes, is that there were still some bad actors out there. There were still some companies that people got really excited about that were not well-run businesses, that did not have the financial standings to really be valued where they were coming into this year. So, the high quality growth names that you're familiar with, especially in some of your investments with T. Rowe, those companies aren't going anywhere. But some of the, if you remember back to last year, the meme stocks, GameStop and things like that, those are a little bit of a different story.
Yeah, thank you very much for that insight. And that's the questions that I had. Did we have any others come in on the chat at all?
Not yet.
Okay, very good. So Noelle, any last comments you'd like to give?
Yeah, well, thanks again, Deb, and thanks to the team and especially Mike for getting slides up and running there for me. But I would just hark back to what I said when I started. As investors and consumers, we've been through a lot this year. And if you have anxiety about, especially your investment portfolios, make sure that you're reaching out to Deb and her team. Make sure that you're in communication with them so that you can make sure that you're focused and aligned on your long-term goal, because these environments are difficult to weather alone.
Yes, and I will echo that, of course. Well, thanks, Noelle. Great information today. That's all that we have. I hope that you found it helpful. If anyone has a question that we didn't answer, if you felt a little shy, just reach out with a phone call or an email and we'll follow up with you directly. And then I'd just like to tell you that our next Elevation Market Update, it will be in September. We'll be recording it and sending it out to everyone a little ahead of the time. So thank you very much and have a good rest of the day.
Thanks all. Take care.
Yep. And we also have our typical disclosure to show here at the end. The information that we talked about today is not the opinion of Kestra Financial. And if you have more questions, you can point your phone camera at the QR code in the upper right-hand side and then click the link that shows up.
Thank you, Mike.